We continue with your study of the accounting cycle, part 2. Now that we've learned how to record business transactions in a journal in terms of debits and credits, these are called journal entries, we're going to transfer that information to what's called the ledger. And the transformation process is called posting. And in the ledger, we are going to then summarize those accounts that have debit balances, or total them, and make sure that total equals those accounts that have credit balances. This is called preparing a trial balance. Now, a ledger is a complete collection of all the accounts of a company. Now, these accounts fall into two groups, balance sheet accounts and income statement accounts. Now, balance sheet accounts are called real accounts because they are permanent accounts, because they're not subclassifications of other accounts. Whereas the income statement and dividend accounts have been created nominal accounts out of the shareholders' equity account. So therefore, they're a subclassification of the shareholders' equity account. And they are temporary records, which at the end of the account period, we fold back into the stockholders' equity. And that will be demonstrated in Chapter 3. Now, every company has what's called a chart of accounts, which is a complete listing of all the titles and the numbers of those accounts in the ledger. It's like a table of contents. And they're usually in a particular order: assets, liabilities, shareholders' equity, dividends, revenue, and expenses. And they are given numbers that range. The asset account numbers range from 100 to 199, liabilities 2 to 299, and so on. So every business has a different set of accounts, account numbers, but generally they follow the same pattern. Here's Microtrain, chart of accounts. Here's cash, account number 100, accounts receivable 103, supplies 107, they give a description of it. Trucks 150. Then we get into the liability accounts, then the equity accounts, and then the revenue accounts are 400, and you see that the expense accounts are 500. Now, this is what a ledger card would look like. They'd have one ledger card for every account. This ledger card is for cash. Cash has been given the number 101. Every ledger card has a date, explanation column, reference column, debit, credit, and an ongoing balance. Now, the process of posting is transferring the amounts from the journal to the ledger account. So here's the journal page. Here's the ledger page. Let's assume October 1st, in the general journal, we recorded a transaction, cash and common stock. Cash was debited, common stock was credited, so obviously the owners invested money in the business. Now we want to transfer that to the ledger. What effect did this transaction have on the account called cash, and what effect did this transaction have on the account called common stock? Well, we start with cash then. Cash, we take out the ledger card for cash, 101, record the date, we could put an explanation in, but this journal entry, or this posting comes from general journal page 1. You see reference back to the journal. And it's a debit, and we have no credit, so the ongoing balance is a debit. Now we transfer, once we complete that, we record 101 back here, so there's a record back to the journal. So at any time we can go in the journal and find out where this was posted, or we can go in the ledger and find out where it was journalized. Common stock, then, we would then pull out the card called common stock and probably have a number of 300, and we would credit it for 10,000 and put the reference back in the journal. Now, once we've transferred all the information from the journal to the individual ledger cards, at the end of the accounting period, we summarize the ledger cards. We have cash. It has a balance of $15,200. We know that's a debit balance. Supplies has a debit balance of $2,500. Prepaid insurance, equipment, notes payable has a credit balance of $5,000. Accounts payable $2,500. Common stock has a credit balance of $10,000. It earned revenue during the year, so service revenue has a credit balance of $10,000, and we paid these expenses. Now we simply add up all the accounts with debit balances and those at credit. And if they are equal, we could be reasonably assured that we recorded every business transaction properly in the journal, and we transferred that information properly to the ledger. Now, a trial balance is simply that, a trial, just to see if your accounting records are in balance before we proceed to prepare for the financial statements. And that's what we will do in the next chapter.